Welcome back. On today's video, we're talking to brand new stock market investors. We want to go through the basic terms because sometimes the market can feel like a foreign language. It's not commonplace. It's not something that you would learn in school. And we want to get you through some of the basic terms and questions that people may have. Before we get started, we do need to make sure we clarify that this is not investment advice. I am not a financial advisor, not your financial advisor. I'm just sharing experience that I have gained after a number of years of having invested in the stock market. So to get the questions that we'll be going over, to get the information that we'll be going over, we researched information on Reddit, X, Twitter, of course X and Twitter are the same thing, investment sites like Investopedia and Schwab. We pulled the top questions from those sites because it seems like there is a consistent theme. So number one term that we're going to go over is, what is a stock? A stock is a portion of a company with a little bit of clarification. It's a security, which just means it's a thing that represents a value of a certain portion of a company. A company can have millions and millions of different shares. However, that doesn't mean that you're actually owning a piece of the company. You're owning a representation of a piece of the company. That distinction becomes important if the company ever runs into financial trouble because they can bankrupt out the stocks and you don't retain any ownership in the company itself. Now, you'll also hear about bonds at the same time as you hear about stocks a lot of times. A bond is a piece of a debt of a company. When you come to the repayment order about who gets paid back first, well, the bondholders generally get paid back first according to a schedule, where the stockholders only get a return if the company is profitable, if there's dividends, or over long term. Long term, stocks should perform very well if the company's profitable. However, short term, stocks can act very emotionally. Next, you'll hear a lot about funds. You can have exchange traded funds, index funds, and what they are is they're basically a basket of stocks. Someone has taken a bunch of different stocks that represent either an index, we'll cover that in a second, or a sector, and we'll cover that in a second also. And then investors are able to buy individual shares of those and be able to own a piece of, again, a sector or an index. Now, what is an index? An index is something like the S&P 500, the Dow Jones Industrial, the Russell 1000 or 2000, the NASDAQ. There's a lot of different indexes, and what they're trying to track is, for example, the Dow tracks the largest companies in the United States, the 30 largest companies. The S&P 500 tracks the 500 largest companies in the United States. The NASDAQ 100 at least is looking at the 100 largest tech companies. And so what you're getting focused on a sector or an index. You can't buy a piece of the S&P 500 directly because that is just tracking the 500 largest companies on the market. However, you can buy a share of an index that tracks that, or a fund that tracks that index. So Vanguard has them, Fidelity has them, Schwab has them. It just depends on which one you want. And when you're investing in a fund, you can also find, let me pull this up real quick, that each has different expense ratios. Now, a fund should be very easy because they're just buying the shares of those largest companies and then swapping them out as they go in and out. But you can see here that there's a bunch of different costs that are associated with different funds. So when you're investing in funds, you want to find one that's tracking the index that you want and then look at the expense ratio, because over time, a 0.04 expense ratio, that means that goes to the advisors to cover their cost. That's significantly less than a 0.18 expense ratio. The expense ratio can be fine if it's generating a better return, if they're doing something better for you, they're more actively managing the fund. But if they're only tracking the fund and all you're doing is paying more to get the same thing, well, that's probably not the best advice for you to do. So the next question is, what is a sector? Well, in the market, you have different sectors, which could be just different areas they focus on. For example, you may have someone that focuses on the financial or the bank sector. You may have someone that focuses on technology, AI, or construction industries, or just whatever the sector happens to be that they're focusing on, and you can buy a fund that tracks that particular sector. This can be good because you don't have to choose individual stocks. You can just choose the sector, and as long as the sector as a whole does well, you can do better. You can follow that at least as well as it does. For example, many people invest in the S&P 500 because historically it's done very well. Over the last 30 years, the last numbers that I looked at is it's returned about 9%, which if you look at your bank account, you're not getting any interest in there, and 9% is better. So people will invest in that fund, understanding it will have high years and it'll have low years. Some years it'll make a lot of money, some years it'll actually lose money. And you need to be aware of that, which leads us to the next piece, which is diversification. When people talk about diversification, it's relating to the old adage of don't keep all your eggs in one basket. you would want to invest in, if you're investing in funds or market sectors, you would want to invest in multiple sectors so that when one sector does well and one sector does bad, they balance themselves out. You don't lose all of your money or take a loss on or at least a loss on the return. Generally, in the stock market, when you're investing in funds, you won't lose all of your money, but you may lose a significant portion if the market does tank, and that does happen on occasion. So with diversification, you're spreading your risk. You're giving yourself the opportunity to be invested in sectors that do well, as well as in sectors that do not do well, hoping that the ones that do well are offsetting the losses. Now, it's not just about hope. In your portfolio, and that's the next term that we're going to cover, your portfolio is a group as everything that you hold. If you hold multiple funds, those make up your portfolio. Everything that you have in the investment world, in your investment basket, is called your portfolio. During bull markets, which is our next term, the stocks generally are going up by 20%, or at least they're overall rising. A bear market, however, is when the market drops 20% or more. Now, so for example, if you have $100 invested in the stock market, a bear market's going to be anytime it goes positive. A bull market, however, is going to be considered when it drops 20% or more. So again, in that $100 analogy, anytime it drops to $80 or less, which could be scary if you're talking about $100,000 or $1 million, you lose 20%, those numbers get a lot bigger, but that is considered a bear market. Normally, it's very temporary. And here's what I mean by temporary. If you look at the graph that's on screen, here's the market cycles, and this is a hypothetical $10,000 investment in 1950. But you can see that the bull markets have historically been much longer than the bear markets. The bear markets generally don't last as long as a bull market, but they can be quite scary when they do happen, and the market can go down significantly. The next term that we'll talk about is volatility. And what volatility is, let me bring this back up on screen. This is where, for example, again, this is the S&P 500. You can see that it goes up and it goes down. It goes up and it goes down. And if you look at the individual days within those cycles, there's a lot of micro ups and downs as well. That is volatility. When it's up and down and up and down, people talk about volatility, meaning it goes up and down, and it's volatile. It's not like your money in the bank where it's one static value. It's going to be up, it'll be down, it'll be up and down, but you can see over time, it does generally trend up. So the typical rule of thumb that I have followed is if you need the money within the next 5 years, you don't want to have it in something terribly volatile that may go down, because then you're not going to have use of it. If you have money set aside for those volatile times, you're able to withstand that and generally come out better because you're still invested long term. Now, this is where you get into the compound interest. And what compound interest simply means is if you put $10,000 in here, you can see that up in this period of time, it's worth almost about $80,000 without putting any additional funds in. And what that means is you have interest that then adds interest on top of, or a return on top of what you invested, and then you get interest on top of that return. And then that return over time gets additional investment interest or gains on top of it, and it's compounding. So you're gaining a compounding effect, which means your money is making more money, which makes more money on top of the money that you just made. That's all that it means when you talk about compounding. So that is the end of our terms that we're going to cover today. The next thing we want to go into is misconceptions in the stock market. Misconception number one is investing is gambling. Now, investing can be gambling if you don't do it the right way, because with gambling, you're just basically picking something based on maybe some statistics if you get that far into it, but a lot of times it's just based on a feeling or a hope that one thing is going to do better than another. Some people do invest that way, where they'll just put money into the stock market and hope that it does better, thinking that someone else will take care of it. That's not really how it works. With investing, and the reason that investing is different, let me pull up this screen again. So for example, this is Google stock. It's actually Alphabet. Alphabet is the parent company of Google. And here's what makes it different than just gambling. Number one, with some of the gambling, you can look at statistics and things like that, especially if you're looking at football teams or horses or whatever. You can see the historical performance. But what you can't see is the current financials, or what would be the statistics of actual performance. Companies in the market are required to report how they're actually doing financially. They report annually and quarterly. And you can see right here on Google stock or Alphabet stock, they've shown from 2021 to 2025, and this is on marketwatch.com. You can pull up any public company and see what their financials look like. You can see the trends. You can see how they've done. We can see that, for example, the sales and revenue, we can see the quarterly trends. We can look at the actual numbers. We can dig into the earnings reports that they put out quarterly. We can see their filings they put on file with the SEC and see how the company says they're doing, and they're not allowed to lie. Now, they can be wrong, but if it's found out that they actually lied or misrepresented their information, then there's penalties for that. This is what you don't get in gambling, is what the actual performance is, what the financials are behind the scenes. And this information can help investors make good decisions. Now, again, like I mentioned earlier, investing in stocks long term should reflect the true value of the company. However, short term, there's a lot of volatility, as we talked about earlier, and emotion that creeps in. For example, when Trump rolled out the tariffs earlier last year, everyone freaked out and the stock market as a whole went down significantly. So for example, let's go back into Google stock and let's look at the 1-year history. And you can see back in April, actually let's go to a 2-year history or a 3-year history so we can get a little better feel. If we look in about April of 2025, the stock here in January was way up. By the time we got down to tariffs, right around here, everything really cratered. And you can see there was a couple of big dips. Now, for those who invested in those big dips and realized that was a short-term thing that didn't really affect Google's profitability, if you look at where it is today versus where it was a year ago, again, let's go to a year so we can see the trend, you can see that the stock market went way, way, way up. Now, it's down a little bit right now, and that is the volatility of a stock. But you can see that for investors who are looking at the financials, recognizing where the benefits are and that the short-term emotional nature of the stock market is, there's opportunities where inefficiency creeps in. And inefficiency just means that the market is not truly reflecting the value of the company. So that's the difference between gambling and investing, is if you're looking at the financial metrics, if you're looking at the details, if you're actually following along and figuring out, are these companies profitable? Yes, you'll make mistakes, but you have a much better way of gaining money than if you're just throwing money at it or gambling. Myth number 2 is you have to have a lot of money to be in the market or already be rich, and that's not true at all. You can start investing with as little as $5. There are companies that will allow you to buy shares, fractional shares of each stock. So for example, when you look at Google stock, you see that it is $299 right now. However, you can buy a fractional share. And what does that mean? Well, each share, remember, is just a fractional portion of the company, or a security that represents the company. Well, companies like E-Trade and Fidelity and Schwab and Robinhood and others will allow you to buy fractional shares. So while the share price may be $299, you may be able to go in for only $5 and still buy a portion of that company. You need to be consistent, obviously, and invest as much as you can, but the fractional buying of shares has really changed the nature of investing over the last decade, where before you had to buy the entire share, now you can just buy a portion of it and still benefit from investing. Now, $5 is not going to make you a lot of money, but $5 every week over time will help a lot. Now, let's jump into myth number 3, or mistake number 3 is what this one is trying to time the market. People think that it would be easy to buy high or buy low and sell high, and unfortunately that doesn't usually happen because we don't really know when the tops of the market are or when the bottoms of the market are. In fact, when we look at the adage of time in the market versus timing the market, people who just simply stay invested through the good times and the bad, typically outperform the market, or typically outperform people who try to time the market. And let me show you a little bit of information on that. So here's a little bit of information on that. The best days typically happen in bad markets. If you look at this chart right here, the 50 best days in the stock market between 1995 and 2024, 50% happened in a bear market. 28% happened during the first 2 months of a bull market. In the first 2 months of a bull market, most people that were scared and pulled their money out, they don't trust the market yet, and they don't go back in. Only 22% of the best days happened during a bull market. That's crazy when you think about how this looks. So let's take a look at this from another angle. If we look at the 10 best days for the S&P 500 in the last 30 years, I wanted to get a good feel for where that looked, and we're going to compare it to the S&P 500. The number one best day was October 13th, 2008. Now, many people may not remember 2008, but that was when the markets really started crashing, the great financial crisis, as people call it. And let's take a look at what the market was doing. So I've pulled up the S&P 500 over here on a different screen, October 13th, 2008. If we look at the market, we can see here it was going up, down, up, and then there's this big crash here. Well, October 13th is kind of right here in this big decline. So it's kind of hard to see, but if you look at this decline right here, there was a big slash down. And again, we're looking for October 13th. Well, that's here at the base of this big crash. And it popped up a little bit, and then it went back down. And again, it kept on cratering. Most people who get scared or try to get out of the market are not going to go back in at the base of this big slide. They're just not going to do it. So you miss out on the number one biggest day. Now you can look at this and go, well, look, the market went down further. And you're absolutely right. It did. Down until early 2009, the market continued to slide, which means you would have missed the number one best day and the number two best day in the market. And you can also say, well, that's great. I missed the biggest downturn. And you're right. So let's look at the next one, April 9th to 2025. Or actually, before we even do that, let's take a look here, because you can see it was a slow grind out of that market. But if you would have missed those two best days, sure, you might have missed it, but I can guarantee most people still didn't trust the market, and we know most people didn't until it dug out several years later. But if we look here, if we go from peak to trough, October 12th, 2007, right about then is when the worst was, or the best was, to February 27th, 2009, that's only a few months, and then it slowly started to climb out, and most people still didn't trust the market until we got here into 2011, 2012, because they had seen this big downturn. And unfortunately, they would have missed some of the best days in the market. Let's take a look at the next one, April 9th, 2025. And if we come up here to 2025, April 9th was right after the tariffs were announced. And again, everyone was still scared about that. And by the time it recovered, most people were not going to be getting back in. Because again, look at this big downturn that you have right here. There was a big crash right away. And most people, again, didn't get back in until they realized that the market was not going to crater, and they missed that opportunity. So timing the market is one of the worst ways to make money in the stock market. Sure, you might catch it occasionally, and you may be able to develop the mindset of when everything crashes to buy something on sale. But you've got to have the discipline to go in. Dollar cost average is what they call it, and that's another term for you, which just means consistently buying shares on a fixed schedule, and you'll buy the average, which is going to be better for you long term. Don't try to time the market on a given basis. It's okay to dabble a little bit, but if you try to time the market, you will actually generally lose more money than you make. Okay, this leads to the next one, is panic selling. When we look here at these crashes, if you sell when everything is on its way down, unless the companies are going out of business, you're basically doing the opposite of buying on sale. You're doing the opposite of what everyone talks about in the stock market of buy low, sell high. If it crashes, if the fundamentals are still good, that's the time to hold on or maybe even buy more, because panic selling is not where you make the money. Generally, historically, markets have always recovered, but the people who have sold are the ones that are basically transferring their wealth to someone else. The next one is chasing hot tips on X or Twitter or TikTok. Do your own homework. Make sure you feel comfortable with it. And unless you have some sort of intrinsic knowledge of the industry or the company, not insider trading, by the way, we're not Congress here, but as long as you have some sort of intrinsic knowledge about the profitability or the company being financially solid, then just hold on. You're going to be okay, and don't go after the hot trends. That's the best way to lose money, again, unless you know that the company is profitable. The last thing that we're going to talk about is fees. Fees matter. If you're buying funds, if you're buying mutual funds, if you're buying ETFs, make sure that you're checking the fees, because there are companies that will charge exorbitant amounts of fees which eat into your return. It comes right out of your return. So watch the details, make sure that you understand what you're doing, and then when you want to get started, open a brokerage account. Go with a company that has good research capabilities. My preference is companies like E-Trade or Fidelity or Schwab, someone that offers a broad range of investment options, but also has good research tools where you can look at the financials, look at the details. Robinhood's not bad, but my experience with Robinhood is they don't really have great research tools that are comprehensive and as easy to see as maybe an E-Trade or a Fidelity or a Schwab. Still a great company, great on the crypto trades, but make sure that you are able to do the research, because we don't want to gamify investing. We want to do it right. We want to understand the fundamentals. We want to be able to look at the earnings, get good insight on the companies, and then pull the trigger and stay consistent and stay safe. Financially, that is. I hope this has been helpful to you. If it has, please give us a like down below. If you'd like to see more content like this, consider subscribing to the channel. And if you know someone this may benefit, do share. Thanks for being here. See you on the next one.